Hello, everyone. My name is Martin Chera, and I have with us Kevin Kim from Gerasi Law Firm. This webinar is going to be discussing a few topics, the current market trends with the conditions that we're in, raising capital in today's market, and the state of private lending. We are a New York-based, asset-based, hard money lender. We specialize in fix and flips, ground-up construction, as well as 30-year perm debt service financing. But again, this topic is all about just information to provide our attendees. And Kevin Kim, welcome to the webinar.
Having me. Happy to be here.
Thank you. So I guess I'll start off with the most important topic that everybody's interested in is the current market conditions. Everybody's asking me as a lender, what do I think? What's the crystal ball? Where we're headed? Recession? Are we not in recession? You know, is it going to get more inflation, less inflation? So just to get your perspective on it, Kevin.
Yeah, I guess my concern has always been there's a lot of weird opinions about this out there that are kind of contrary, but I'm just going to go on the strict definition of what is a recession. Is negative GDP growth the past 2 quarters, right? It's happened. We're in recession, right? But whether this is going to be a soft landing or, fall on your face landing, it's hard to tell right now. I don't think it's 2008. I think inflation seems to be getting under control to some degree, but it's still pricing is, real estate pricing is a different factor, but I think consumer price index is not a good indicator for our clients to really make a decision. The concern right now is more along the lines of rates, volume of loan activity, and inventory. And that's where a lot of problems lie. Now, in the northeastern market where you guys are, there's a lot of inventory still available. Deals are getting done, and it's a positive sign, right? It's a very positive sign. And we look at the Midwest and the Western markets, not so much, right? So volumes are down significantly across the country. Thankfully, though, we've been tracking this data over the past few months, and it's gone up a lot from February to March. So everything is looking positive in the past 2 months, trending upwards. As compared to the last quarter of last year, things are trending downward. So it's a good sign. But overall, I think that if you are a I guess you can call it seasoned professional real estate investor or developer, I think you can figure out how to get a deal done right now. And I think that's, if you're a speculator, if you're like a brand new person or hobbyist, might not be the best time, right? A lot of lenders are being very selective. I think that's a smart move. But yeah, consensus seems to be in resi, at least we're still pretty solid. Yeah, rates are up, but deals are getting done. So.
And why do you think that the market trends are going up the past few months in the West Coast? Like, is it more inventory?
Well, it's actually national. So we track national data here at the firm because we draw up loan documents and serve lenders across the country of all shapes and sizes. So we have a data source through our Lightning Docs platform, and we're able to track the whole country. The fascinating part, I think a lot of it has to do with rate environment, right? We've finally come down below 6 on mortgage rates. I think it's like psychological. I really don't think it has much of a difference economically. It's 30 basis points different, but it's a big deal for a lot of mortgage lenders, right? And so that's on the conventional side, that's really driving a lot of people off the sidelines. I think also a lot of lenders have figured out their capital. This has been a problem for a very long time, right? From June until October of last year, capital markets in our sector have been wishy-washy at best, right? So, and I think from November onwards, most, direct lenders have found other resources, and then the capital markets providers have also found other resources. So things are starting to get kind of normalized to some degree, and they figured it out. And so, January was not so good, but trended upwards to February, and then I think we saw a 60% increase up to March, and things are looking good in April. So overall, people in the space seem to be optimistic. We just had our conference, Innovate, in Newport Beach yesterday. Today's April 19th. And we had it yesterday on Tuesday on the 18th, and it was a very positive mindset. Everyone was like, yeah, things kind of are tough, right? We've got headwinds, but, we're going to figure it out, and the industry is going to be fine. So.
Right. And that's, that's my perspective also. A lot of people are saying the same thing over here. on this side of the coast. But do you see also like sellers that want to sell because now that the rates are coming down, they can afford to buy a larger home or a smaller home and downsize? Is that what the data is showing also?
I think it's showing. I think it's showing the ability to make this, like the ability to make a decision, because now their mind goes, well, it's a little bit cheaper, and I need to move, right? So I need to buy something. There's still a lot of pent-up demand, still a lot of desire to buy a home, or sell their homes, right? So what's fascinating though is that the data still shows that there's a massive, massive undersupply of inventory in housing, and rentals are still, DSCR loans are still very, very popular and still getting done. And I had a lot of lenders ask me that yesterday, like, how are these getting done? I mean, they're so expensive. It's about, if you can make it pencil, it'll work, right? You can make it work, right? And rents are coming up a little bit, So I think overall, people are figuring out kind of the new terms that are out there. They're understanding what the general consensus is, that rates are all up in our space and then conventional, but they were scared when they were above 6. Now that they're 5.7, 5.6, I haven't checked today, but they were, and like that I think that gives them a little more comfort, So
Right.
yeah,
I'm just telling my borrowers, look, the rates are what they are. There's nothing you can do right now for the next year or two until the inflation deflates, and also we have a new president. So people have to just
yeah,
get used to this new environment. I'm sure you know this as well as I do. In 2016, 2017, we were at an 8, 9, 10% on debt service loans. So
yeah.
that was the norm then, just going back about 5, 6 years ago. Correct?
Yeah, I mean, it was well, I mean, combination of two very, very different factors. But yes, I mean, DSCR paper back then was a lot more expensive. But then we saw the advent of rated securitization in the DSCR sector, and a very, very low interest rate environment post-COVID. And that really pushed everything up. And I think that people got really used to that really fast, right? Because in a matter of a year and a half or 2 years, they were used to very, very, very low interest rates. And that was an interesting phenomenon. But we have the same problem on the consumer side and the conventional side. Me personally, right? I'm not going to sell my house. I'm at a 2.5% mortgage, right? So
Right.
the advent of the accidental landlord, right? There's articles about that all the time. But I think the consensus was across the industry from yesterday, and my personal opinion has always been this way, is that the market will always, like, smart money will always find a way, right? And borrowers who are serious, borrowers who are getting there, who really are professionals, they're going to make it work. So
Right. And also in times of contractions, and this year span, I'm going to say that we've been in, this is the time for smart investors, smart lenders, smart business owners to figure out ways to get out of this wave and be prepared for even the next wave. And that's what
right.
we're doing, and other the smart business owners are doing also. So with that topic, I mean, what do you feel like? What is the capital strategy today of lenders to do to ride this wave out and be prepared for even the next wave?
If you're a lender, right? If you're a private lender right now and you're local or regional, it's like you're lending in, one city, or maybe, one county or region, then you're going to be just fine, right? Because you know how to price your backyard. I hope you do, at least, right? And hopefully you figured out that you can't rely on Wall Street to buy all your paper, or table fund all your paper. Their buy box is going to be different than what you might be used to, right? And it's a moving target, and that's okay, because they have a lot larger goals to achieve, and you're not one of them, right? They want your loans, but that's as far as it goes. I'm concerned about lenders who've gotten to that, almost to that, not national, but they lend in probably 5 to 10 states. That's where things can get a little concerning, because a lot of those folks are very reliant on capital markets. They're reliant on selling their loans to Wall Street or the institutions. And some have done quite well with that still, even through all this volatility. But they made inroads very early to lock their counterparties down, and their volume and their business supports it. The challenge is going to be people who don't have it locked down to the desires of Wall Street secondary market, but also don't have any discretionary capital or high net worth investor relationships, and they're going to be stuck. Right now, capital is very precious, and so, and the proof is, the fact that my team was so busy from November, I guess October, until February, because we do the primary thing that my team does for the private lending industry is create debt funds. We do debt funds, right? We do securities work for private lending. We're busier than ever from October, I guess even October, September, all the way into February, because lenders started to realize, well, if I can't rely on these, correspondent or table funding programs 100%, I need to figure out my own capital. And then other folks, they already had capital, but it was kind of I'd call it an informal friends and family arrangement. And so now they want to formalize. They can go out there and go tackle some bigger investors. And this has become the trend, right? And I think this trend is here to stay, because within the span of 3 years, we saw Wall Street come in, come out, come in, come out, come in, come out, right?
Right.
So, and it makes sense. The asset class is untested. It's not really, you can't rate it. You can't rate these loans, unlike you can rate, conventional paper, even DSCR. So that's where the market is probably going to head. And I think as we progress long term, it'll get better. I think capital markets will return. They're already returning. Loan buying activity is up. Many of the aggregators that we're close with have told us, hey, we're back. Pricing's not what it used to be, but we're back. And I think, like you said, as interest rates I don't think they're going to come down that quickly, but I think they'll stabilize. As they stabilize, I think the bond market will come back, which means a lot more volume. So
a lot more what?
A lot more volume, and we're going to have a lot more volume. Well, once the bond market comes back, securitizations are getting done. Pricing can be consistent. It'll come down a little bit than what it is right now. And it'll be a good thing, right?
You were saying some of the aggregators are coming back, and we're seeing the same thing also. They're calling us up and all that. But are there any new aggregators out there that's also coming into the industry? Yeah.
Plenty. Yeah. I mean, there are always going to be new ones, right? And they're going to be, I guess we can call it reorganized ones, right? Like ones that existed before, find new counterparties, come back, new organizations that have figured out opportunities, smaller organizations that were around before and scaled up. So, yeah, I mean, buying loans has become quite the interesting business model in our space. And, effectively, if you have a capital markets background, you come from Wall Street or some type of life co business or whatever that is, you are going to create that instead of becoming a direct originator. What's fascinating is that it's a very broad swath of capital sourcing, right? You've got folks that are back through life co, some folks that are, retrading loans to Wall Street, some guys that are securitizing themselves. The same players are in the space. There are new, smaller ones. Overall, though, what I'm seeing is that we're starting to see some direct activity from the upstream buyers, which is good. We started seeing New York Mortgage Trust come to some events. They were out of the game for a long time, but they were also buying from the aggregators. They seem to want to go direct to the market. Man Group is coming direct to the market, which is great, right? Groups like that are coming direct to the market, which is fantastic. Companies that we had kind of counted out because they were more conservative, their box was more conservative, they're gearing up. And so I definitely think that there's going to be a lot more activity. I always tell lenders, though, just be ready for an increased pricing model. It's not going to be a 7% buy box, 8% buy box, right? They're buying at, I mean, the national average right now, I think, is about, I want to say around 10.5 to 11%. And that's factoring California, right? What you guys are is well above 12, probably, so
10.5, 11% on a hard money or debt service loan?
Hard money, yeah.
On a hard money.
Debt service is probably more closer to 8 and 9, right?
Closer to 8, yeah. Got it. True. Yeah, some of those aggregators are calling us up, but the debt services are, I don't know, for some reason they're still very high. They're coming in over 10%. And I'm like shocked.
Yeah.
But
they're getting done.
They're definitely getting it done, yeah. But I guess volume also speaks word. The more volumes you do with, more volume you do with them, maybe the rates will somehow become lower. But to me, this is just like a thunderstorm and a rainstorm on the highway. You just got to pull over and wait. This is what it is, and we're just the lenders and the aggregators just pulling aside, sometimes just waiting.
Yeah.
But the strong will survive. The smart ones will survive. That are preparing themselves for the next 2 years to be strong and powerful, I guess, in this particular industry and economy that we're in. Just curiosity, I mean, when do you feel that the rates will simmer down? I mean, my perspective was in about 2 years. It takes time for the monetary policies to take effect, from the wages to decrease, from the recession to hit, to the volume of transactions in real estate. So, I mean, my perspective is about 2023, 24, 25, and that's when a new president should come in. Again, just my perspective, the debt service loans probably will come in the sixes, the sixes and the fives, then a year or two more back into the 3-4%. What are your thoughts on that?
I think I agree with that. I think to bring the market rates down as a whole, to bring Fed rate back down and prime back down to that level where 3-4% might, 2 years or more. I mean, I always think back to, like, when I joined, when I became an attorney, your average interest rate was 8%. And so, it was kind of like, okay, that makes sense. It's post-recession, everything was up. And we started seeing downward pressure, but it wasn't that dramatic, right? It wasn't going from 8 to 4. It was a trickle down over time. So I don't think they'll do a dramatic price down. I think that they're trying to cool the economy off on purpose. Whether the intention is somewhat okay, I think, but the results are not what they're expecting, I think. And so that's what I'm worried about, because they're not solving for one big issue, right? We don't have more housing. We need more housing, right? So we need more inventory, but local government is not making it easy to build. So, and interest rates are very, very high. No one can buy, everyone wants to rent. These are the challenges that we're facing nationwide. And in states like mine in California, it makes it worse when you have, taxes like the mansion tax up in LA County, right? Or the city of LA. And so it's really fascinating what we're seeing nationwide. Like, what are local governments doing to incentivize construction? Some are doing better than others. I think, they're doing really well in Florida with this. They're doing really well in Texas in this. But at the same time, if the cost to build that property is just, right now the average construction loan is probably 12 to 15%, depending on where you are in the country. Just too much. So these things got to be figured out. I really think that probably coming this summer, I think we'll see some consistency in capital markets, which will rejuvenate the industry to some degree. And then starting in 24, we'll start to see a slight decline, maybe a 25 basis point, 50 basis point decline. And it'll be a trickle down. I think so.
Right.
Unless we have another all of a sudden crisis on our hands. If all the banks all of a sudden fail, then they may drop it down. Who knows, right?
God forbid. God forbid. Yeah. So talking about
no one
the
saw the
banks,
banks coming. So
right. And just talking about the banks, like, how does this affect the private private lending industry? What is your perspective on that?
Yeah, it's interesting. We talk about this a lot at the conference yesterday. And it's interesting because I feel like on the residential side, the 2008 recession led to the advent of private lending as we know it today, but also created the opportunity for privately held non-bank, right, conventional shops and mortgage banks to be created, right? And until then, it was banks, right? I mean, back before the recession, it was mostly just banks, like Countrywide. It was just banks. So I think this story rings true again, and this is now going over to commercial, right? And so for your listeners who are actively involved in multifamily, small balance commercial loans, or investing, this is going to be an interesting result. I think this is going to create more opportunity for private lenders, non-bank lenders, whether you're an institution or not, right? Non-bank lenders to really, really take over the mortgage side of that world, right? And so I think you're gonna. I don't think banks are, but I don't think banks could ever do anything that's not your middle of the fairway 55 LTV term loan on a construction on a commercial real estate deal. They can't do bridge anymore. They can't do construction anymore. They're going to be precluded because of the risk. They're scared of risk. And so I think that, I think in the grand scheme of things, it's a positive for us. But it's going to take some time. There's going to be a massive glut of opportunity for that small balance, multifamily, self-storage, small industrial. It's going to come our way. And I think that it's the 1 to 10 million size deals that our world, our industry will be able to scoop up, because those deals are kind of overlooked in the CRE sector. And then if you think about what's going to happen as well is, we talked about this yesterday, JP Morgan, Goldman Sachs, Blackstone have all created new allocations to acquire private credit. Well, when I heard the news of that, and I saw that, I felt like that was code for distressed debt. I think it is. I don't know for sure, but I think it is. And it's primarily going to be on the commercial side, which tells me if you are a private lender and you have the ability to access private capital, I would start thinking about some kind of distress strategy and being able to take advantage of these distress opportunities that are going to come your way.
So I'm sorry, what were you saying about the banks? What are they going to be doing? They're going to be lending to a lender like me, or getting into
I
the
think banks
market?
are going to be out of real estate finance, basically. I think they're out.
Holy
I think
shit.
they're not going to be able to. I don't, because, until now, banks have been, a lot of these small regional banks have been competing with private lenders on the commercial side, right? They've been competing with a lot of my clients who do construction loans, both on residential and on commercial. We've seen banks jump in. And, JP Morgan had a $5 billion allocation into commercial multifamily bridge. That's no longer a thing anymore. I think overall, they're going to be precluded. And so we're going to see more companies jump into the small balance bridge sector. And I think that that's going to become a really popular product in our sector as well. And it used to be kind of, 60-40. When I first joined the space, it was 60-40, right? 60% resi, 40% commercial. Most folks, it was a big blend of things. When 15 hit, 16 hit, and all the aggregators jumped in, all resi. So I think that there's room for it. And I think right now, the immediate question is going to be, is it distressed paper? Is it refi? Is it rescue? Or all of the above, right? So if you are a distressed note buyer, you're going to be excited, right? And it's time to get capital. Yeah. But it won't be in resi. I don't think it's going to be in resi. It's going to be, these 25 door, multifamily projects, these ground up construction projects that got screwed over, right? There's a lot of that happening right now.
But if the banks are not going to be doing it according to what you're saying, but a bridge lender needs a takeout, how are they going to take it out? Like, what's the
Well, the beauty of the takeout market's already been built over the years, right? There's been a massive, mortgage banking sector created that's kind of privately run. That's a non-bank organization. That's also agency, right? So for multifamily, you have Fannie Freddie programs that exist for the small balance commercial term loans. So we saw a ton of this happen, like bridge to Fannie, bridge to agency was a huge product in multifamily. And I think it became a very institutionalized product. I think that's no longer going to be the case. I think banks are not going to do it. I think banks are not going to fund any of it. They're going to get away from all of it. And it's going to be the private organization, whether privately, non-bank organizations are going to be doing this. And I think it's going to create similar tailwinds in the CRE sector. And for private lending, I think it's going to push a lot of us over to start looking at some of the small balance stuff, right? Sub $10 million transactions, and really start thinking, well, this is a good opportunity. And maybe I should do these deals too, so.
Right. Okay. Awesome. Okay. Just see if there's anybody have any questions or anything. I forgot to do a little rules of conduct. Anybody has any questions at all? By the way, you can put them in the Q&A, and we'd love to hear them. And so you could ask Kevin. Forgive me, Kevin, I didn't kind of introduce you so much, but He is a lawyer for a company called Gerasi that does corporate and security divisions of the firm. They're the nation's largest firm exclusively dedicated to the private lending industry and the nationally recognized experts in debt funding formation and private lending. So that's what Gerasi firm does, and we use them also as well too. So you are seeing a lot more aggregators come to the market, a lot of more private hard money lenders, and you feel from your perspective that it's only going to get stronger for a bridge lender, hard money lender in the capital markets because banks are retracting, whether they're retracting on the leverage, retracting on a deal, or whatever it may be. That's your perspective. Am I correct?
Yeah, I think it's going to come on. I think it's going to increase. I think, we're probably going to see some interesting moves from a direct placement standpoint at the institutional level. They're going to start coming downstream directly. But yeah, I mean, listen, they love this product. It's the darling of Wall Street. It's a great product for them. Really, what raises questions for me is going to be what's going to, if they can figure out how to rate this product in the bond market, that's going to give a lot of horsepower to the space, but we'll see. I don't know how easy that's going to be, but if they can do it, I think it might bring more horsepower, bring more eyeballs to the space, and that's just bring more capital. I don't know how volatile it'll make it, but I think it will definitely provide more opportunity for liquidity when it comes to your direct lenders. So,
got it. Okay. Is there anything else that you could, give some information out to us, our attendees?
yeah, I mean, I think right now a lot of folks are kind of wondering, like, what should I, if they're a lender, they should be they're asking, what's the immediate next step? If they're local, a lot of folks we met yesterday were doing, they're kind of local lenders working with their friends and family on high net worth investor deals, and they're like, well, I want to scale this damn thing. What do I do now? Because the market is taking a dump, right? And I agree, the market's in a weird place. But I think that, if you start thinking about, well, let's look at what other shops that we aspire to, right? Let's look at the shops out there that have done it, right? And let's look at them. And it may not be this big, $5 billion in origination, $500 million a year shop. It can be a $50 million asset under management local shop that you feel have kind of, it's a good, thing to aspire to. That would be the next homework assignment I would give to a lot of the smaller lenders out there who are trying to scale. Right. Find companies that you admire and you feel that have done what you would want to do with your business. And the lovely part about our space is that it's very entrepreneurial, but people aren't they're not adversarial with each other, right? What I've discovered over the years is that even people who think they're competitors tend to share notes, and they can figure out a way to work together. An abundance mindset, right? And I think that that's a really, really cool thing about our space. And so, I would start, this is the time to learn from each other, ask questions about, hey, if this shop is really cool, and I really want to see what they're doing, can I talk to the principal, right? And you can do that at networking events, you can do that wherever. But I think the goal there, I think that's a really good idea right now. And also, I think right now, I would tell anyone who's kind of struggling is don't overcomplicate it. Do good loans. Live to fight another day. If you got some paper on your books that are it's a little bit wonky, it's a little bit underpriced, or maybe it's values are kind of concerning, I'd say just do what you can to get it off the books as fast as possible and live to fight another day. Yeah, it's gonna sting. It's gonna sting, right? You may have to lose a little bit of money, but rather you survive than have to deal with all this kind of markdowns, and all of a sudden now you got investors that are pissed at you and trying to sue, right? So, yeah. So that's been the kind of consensus yesterday. A lot of folks have loans that they don't love them, right? So but there's a way to get them off the books, and do that. Again, the thing right now is just about survival and doing good loans.
Yeah, hey, listen, if they have to take a hit, let them take a hit. But at least, like you said, it's off the books. And I like what you said. Look at other companies, aspire, take a look at their ideas. And that's something that I do as a lender also. I'm a very, small, medium-sized lender, but I look at 2 to 3 lenders. What are they doing right? I try to mimic them, and I do talk to them. And if they give me their advice, it's very, it's very appreciative and all that. And like you said, it's a big space, but yet it's a small space, because whenever I'm talking to clients sometimes, and they tell me, oh, I got to deal with this other lender and they don't want to do it, well, I'll call that lender, or vice versa. They'll call us, and we'll talk about what we don't like, or I'll ask them what they didn't like about it. And, if I agree, I won't do it also. So I like what you said. It's very true. Call up your other lender if they're competing or they're not competing, or they threw away the deal, and find out why, because, it is a very friendly industry. Of course, if you got the right, character.
I agree with that. Yeah, 100%.
Good, okay. So we do have a question here. Let's see what it says. So Gary Wallen from Vintage Capital, we are still seeing a lot of activity in the small balance arena of 250 to 5 million. We also have added other classes.
I
Okay.
agree with that. There's a lot of activity in that market right now. If you're in a small balance commercial, you're gonna be busy right now. Yeah.
Yeah. I mean, our small balance is from 250 up to 10 million, multifamily and mixed use. We're also doing commercial bridge right now as well too, from like 1 million up to 20 million. But a lot of activities.
It's a massive gap right now. It's a massive gap there right now. Every lender that was doing that stuff is in trouble right now, because a lot of them are banks and selling AB pieces, and they're underpriced. Everything is just upside down in that sector. So it's a good time. It's a good time to be a lender in that sector right now.
I hear you. We do have another question here. Are you asking a question, Gary? Carrie, is it?
Oh yeah, Kerry's just clarifying what he said. Yeah.
Of the asset classes. Okay, I got it. Got it. Okay. Very good. Any more questions, anybody? Nope. All right, Kevin, appreciate your time, education, resources. It's great information. Hope everybody appreciates it and takes it to grow your company, to grow your industry. Hopefully it's a hard money lending, and that's about it.
Thank you very much for having me.
Okay, thank you so much. Have a great day, everyone. Thank you for coming.
Bye.